Welcome to this basics module. Today we're going to be covering the daily trading routine. In this module, we will cover the utility of having a daily trading routine, how to correctly implement it, and then go over some tips and tricks on how to best use it. By developing a daily trading routine, you can be prepared for the day ahead. As if you don't have a plan, your plan is to fail. You should know the trade before you see it. Having a daily routine will also allow you to avoid fear of missing out and avoid making emotional decisions. And you can focus only on the pre-planned trades with calculated risk in advance. To begin implementing your daily routine, we recommend that you take the following first steps. First, mark out key levels. For example, horizontals, support resistance levels, high volume nodes, and naked points of control. You should plan all possible trade setups, both bullish and bearish. Then you take the trade that comes to you, and you only enter the trade if the criteria for the trade setup are met. Market context is extremely important as a part of your daily routine. You should determine the market context every morning, as it provides a base understanding and structure for the trading day ahead. Then you can also review new data since your last market context check. An important aspect of market context is the trend direction. You should determine the trend direction to see if price action is going sideways or is up or downtrending. You can use the 15-minute to 1-hour time frame for day trading and the daily time frame for the high time frame trend. Your trading approach changes in trending versus ranging days. As for example, on an uptrend day, you can aggressively buy the dip and trail stop losses versus trading only the edges of the range on a sideways day. Elliott waves can be very helpful to provide further market context. For this, you should take a look at a high time frame Elliott wave count. For example, in a wave 3 impulse, it is possible to aggressively buy the dip, compound the trade, and trail stop losses. However, in a corrective triangle, for example, you should look for ranges, take profits regularly, and only take the best trade entries at the edges of the range. Another important aspect to determine market context are CVD divergences. The cumulative volume delta divergences can provide context of what the larger traders are doing, and you can check on the 15-minute and 1-hour timeframes. You should ask the question, where is price trying to go, and is it doing a good job getting there? Then you should check, are larger traders causing absorption, as this can help you create bias for the day. As part of your daily trading routine, it is important to be aware and make a note of important levels. These are the Fibonacci Champions Channel, or 618-266 retracement, both globally and locally. Also, the VWAP, volume weighted average price, for the session, anchored VWAPs, and possibly the weekly VWAP. Also, points of control for the daily, weekly, and monthly timeframes, for the session, based on time, and naked points of control. Further important levels to be aware of are the value area high and value area low, both globally and locally. Also, the daily open and the previous day, week, and month open, high, low, and close levels. Also, the 4-hour EMAs, specifically the 55 and the 200, can be used, even though this method is inferior and obsolete. The next step in your daily trading routine is to determine key horizontal levels. These are very strong levels with the highest confluence. If broken or claimed, you can expect a support-resistance flip. It is also highly likely that a trade will be taken at this level. The next step in your daily trading routine is to check the volume information. 1. Open interest. Has it changed compared to the previous day? 2. Daily volume and delta for the previous day. 3. Funding. Is it bullish or bearish? You can record statistics. Is open interest increasing over several days or perhaps decreasing? Is volume also increasing or decreasing over several days? What about delta? And how is the funding evolving? Finally, to complete your daily trading routine, you can make a note of key opens and general notes for the trading day. You can make a note of the daily, weekly, and monthly opens. Then you can decide which asset are you trading today. The key notes can involve expectations for the day ahead. Now let's go over some tips and tricks. We strongly recommend that you make a daily trading sheet for yourself. Here, you should make a note of all the key reference levels. This will allow you to be prepared for the trade setups before they become visible. You will be aware of the key levels, and then you can observe the market context as these levels are approached. Here is an example of a daily trading sheet. As you can see, it includes many levels corresponding to today's price action and also more global levels, which will probably not be visited on the specific day. Nevertheless, it is good to be aware of the high time frame situation. You can use this as an orientation, and we encourage you to create your own daily trading sheet with the levels that you prefer and that you use the most for your trade setups. Investing about 30 minutes to prepare every morning provides you with an edge over the competition. You will know exactly what you're doing, long or short, before the trading day has even begun. When the alert goes off at the key level, you can then review the situation with order flow and decide within 1 to 5 minutes whether you can take a trade or not. Here is the take-home message for this module. With your daily trading routine, you will be able to plan your trades and have an edge over the competition. Be ready to trade when the alert goes off, and most importantly, you will understand the trade before it even appears. This concludes today's module. Thank you for watching, and I'll see you on the next one. Happy learning and happy trading.